Opening too many goals is a cash flow design problem. Many people do not lack financial goals. They have too many goals sitting on top of the same paycheck. A home down payment, retirement investing, children education, travel, parent support, debt payoff, and an emergency reserve may all be reasonable. The problem starts when every goal is treated as equally urgent and equally flexible. This video gives you a practical priority map based on time horizon, flexibility, and failure cost. The goal is not to shame any dream. The goal is to give each dollar a job before products, headlines, or comparison decide for you. Step 1. Stop calling every goal the same kind of savings. Emergency reserves are defensive money. A down payment needed in 2 years is deadline money. Retirement is long-duration compounding money. Travel and lifestyle upgrades are preference goals. These goals should not use the same tool, risk level, or review cycle. If short-term money is invested too aggressively, a market decline can damage a real-life plan. If long-term money is kept too conservative forever, inflation and miscompounding become the hidden risk. Sorting goals begins by separating the mission of the money. Time horizon sets the risk boundary. The first ranking axis is time. Money needed within months should prioritize liquidity and stability. Money needed within 1 to 3 years should avoid relying on market recovery. Goals 3 to 7 years away can sometimes be layered between safe assets and growth assets. Goals 10 years away may have more room to accept volatility. Time horizon does not remove risk, but it tells you whether you have enough time to wait for risk to repair itself. The closer the deadline, the less you can depend on markets being convenient. Flexibility tells you what can move. The second ranking axis is flexibility. Some goals can move in time, such as travel, a car upgrade, home decoration, or optional courses. Some goals can change in size, such as wedding scale or discretionary spending. Other goals have low flexibility: rent, minimum debt payments, essential insurance, medical reserves, taxes, or tuition due soon. Low flexibility goals deserve funding methods that are more stable and visible. High flexibility goals can wait, shrink, or be funded with bonuses. Failure cost tells you what must be protected first. The third ranking axis is failure cost. If a goal fails and the result is only delayed enjoyment, it may wait. If a goal fails and the result is high interest debt, forced asset sales, family stress, insurance gaps, education disruption, or retirement cash flow damage, it deserves stronger protection. Failure cost is not fear-based planning. It is the process of identifying which parts of life cannot afford to break. When resources are limited, protect the pillars before upgrading the decorations. Build a 4-layer goal map. A useful map has 4 layers. Layer 1 is survival and stability, emergency reserve, essential protection, minimum debt obligations, and basic living cash flow. Layer 2 is known deadlines, down payment, tuition, tax bills, relocation costs, or planned family expenses. Layer 3 is long-term freedom, retirement, long-term investing, and future care reserves. Layer 4 is lifestyle upgrade, travel, car upgrades, hobbies, and optional consumption. The point is not to shame Layer 4. The point is to stop Layer 4 from consuming Layer 1. Define the minimum acceptable version. Many plans fail because people only write the ideal version of a goal. A home goal may have an ideal neighborhood and size, but it also needs a minimum acceptable version. A travel goal can have a premium version and a delayed version. Education funding can be separated by year instead of treated as one giant number. The minimum acceptable version gives you a controllable adjustment point when income, markets, or family conditions change. It also reduces guilt because you are not abandoning the dream. You are defining the floor. Allocate cash flow before choosing products. After ranking goals, do not start with products. Start with monthly cash flow. Income comes in, essential spending and obligations come out. Then money is assigned to stability, deadline goals, long-term investing, and lifestyle upgrades. If every goal only receives whatever is left at the end of the month, the loudest goal wins. A fixed percentage system is not perfect, but it prevents your priorities from being renegotiated every day. The plan becomes a repeatable operating system instead of a monthly argument. Use 3 questions when goals conflict. When 2 goals compete, ask 3 questions. Which deadline is closer and less movable? Which failure would create more damage? Which one can be temporarily underfunded with a realistic recovery plan? For example, retirement is important, but if the emergency reserve is empty, a short-term shock can destroy the long-term plan. On the other hand, if the safety reserve is complete and all new money goes to lifestyle upgrades, retirement freedom is slowly crowded out. The questions make trade-offs visible before emotions take over. Make family priorities visible. Household finance often breaks down because priorities are implied rather than written. One person may value home ownership, another may value education, another may value caring for parents, and another may want life to feel less restricted. Without a shared map, the discussion sounds emotional because the real conflict is hidden cash flow allocation. A written map makes it possible to protect non-negotiable goals while still leaving room for flexible goals. It turns a vague debate into a shared decision table. Review periodically, not emotionally. Goal ranking should be updated but not rewritten every day. A quarterly or semi-annual review is enough for most households. Check whether income changed, whether family needs changed, whether interest rates or housing prices changed the timeline, whether the emergency reserve was used, and whether investments drifted away from the target allocation. Rules guide daily behavior. Review dates, update the rules. This protects the plan from social media pressure, market noise, and comparison with friends. A practical way to begin is to create one table with these columns: goal name, deadline, minimum amount, ideal amount, flexibility, failure cost, current monthly contribution, and likely funding tool. This table often reveals that the most emotionally attractive goal is not the most urgent one. It also reveals where a household is double counting the same cash flow. If $1 is promised to a down payment, a vacation, and retirement at the same time, the plan is not diversified, it is overbooked. The goal map turns that overbooking into explicit trade-offs. Bonuses and raises need a route before they arrive. For many households, regular monthly cash flow is already tight, so progress comes from raises, year-end bonuses, tax refunds, or side income. Decide the split before the money arrives. Some can rebuild safety, some can fund deadlines, some can increase long-term investing, and some can support lifestyle. Without a pre-written split, extra income often disappears into the most visible desire. With a split, progress feels both disciplined and livable. Summary: when goals are too many, do not sprint toward all of them at once. Rank them by time horizon, flexibility, and failure cost. Put them into a 4-layer map. Define the minimum acceptable version. Assign monthly cash flow before chasing products. Then review the map on a schedule. This content is for financial education and general perspective only. It is not personalized investment, tax, legal, or financial advice, and it is not a recommendation to buy or sell any financial product. Financial decisions involve risk, and your own income, obligations, taxes, insurance, and time horizon matter. A decision ladder start with a decision ladder, not with products. First, list expenses that must happen in the next 12 months. Then list goals that are likely within 3 years. Only after that should you list 10-year and lifetime goals. This order matters because different money has different jobs. Near-term required money needs timing, stability, and access. Medium-term money needs steady accumulation and controlled downside. Long-term money needs persistence, growth exposure, and a plan that can survive bad headlines. Once the jobs are separated, the funding tools become easier to discuss. Flexibility should be tested because flexibility is not about whether you like the goal. It is about whether the goal can move. A vacation can move from 10 days to 5 days. A renovation can move from full home to one room. A car upgrade can wait another year. Tuition due next semester, rent, taxes, minimum debt payments, and essential protection usually cannot move as easily. A low flexibility goal may not be the largest goal, but it can create the most stress when it is unfunded. Ranking by amount alone misses this pressure. Household stress tests make the map practical because you use household stress tests. Imagine income is reduced for 3 months. Which goals still must be funded? Imagine markets fall 20%. Which goals cannot depend on selling assets at that moment? Imagine a family medical or care expense appears early. Which goals can pause and which goals should continue? These scenarios are not predictions. They are tests. A priority map that survives these tests is more useful than a beautiful spreadsheet that only works when everything goes perfectly. A monthly allocation example can show the trade-off because use a monthly allocation example. Suppose a household has $1,000 of monthly surplus. The first portion rebuilds emergency reserves until the safety floor is reached. The second portion funds known deadlines. The third portion supports retirement and long-term investing. The fourth portion funds lifestyle upgrades. If the safety reserve is complete, more can move toward deadlines and long-term freedom. If the reserve is used, the next review period temporarily sends more money back to safety. This is not a universal formula. It is a conversation starter that prevents every dollar from being claimed 3 times. Pause conditions should be written before emotion appears because write pause conditions before emotion appears. A job loss, emergency reserve below the floor, a medical need, or an upcoming deadline can justify pausing lifestyle upgrades. A friend's purchase, a social media trend, or a short market rally should not automatically rewrite the family safety plan. Written pause conditions make the system calmer. They also reduce guilt because pausing a flexible goal becomes part of the plan rather than a personal failure. A review rhythm keeps the map alive because connect the map to a review rhythm. Each month, check whether contributions happened. Each quarter, check whether the ranking still matches income, deadlines, and family needs. Each year, update large target amounts and assumptions. Reviewing too often makes the plan emotional. Reviewing too rarely makes it stale. A good goal priority map is not frozen forever. It is updated at the right interval, so the household knows why one goal comes first today and when the next goal gets its turn. Minimum standard and ideal versions help, because separate minimum, standard, and ideal versions. The minimum version protects the purpose. The standard version gives the household a comfortable target. The ideal version adds quality or preference. This 3-version design helps when cash flow is tight. You can still protect the minimum without pretending the ideal version is affordable immediately. It is especially useful for home purchase, education, travel, and care goals because those goals often have emotional meaning as well as financial cost. Debt and insurance belong on the map because treat debt and insurance as part of the map. High-interest debt can quietly outrank attractive goals because it compounds against the household. Essential insurance can also outrank lifestyle spending because it protects the plan from large shocks. This does not mean every debt must be eliminated before any investing or every insurance product is necessary. It means debt cost, protection gaps, and cash flow risk should be visible in the same map as dreams and investments. The final output should be a rule, because the final output is a rule, not a mood. The rule might say, protect the emergency reserve first, fund deadline second, keep retirement contributions at a minimum floor, use bonuses to accelerate the most underfunded priority, review quarterly, do not change the order because of one emotional. Conversation. A rule like this gives the household a stable default. It does not remove judgment, but it stops every decision from starting at zero. Goals with external commitments deserve special attention because goals with external commitments deserve special attention. Signed leases, tuition due dates, tax deadlines, insurance renewal dates, medical needs, and minimum debt payments are not the same as wishes that can still be redesigned. They create outside consequences if ignored. A goal that has an external commitment may need a safer funding path even if it is less exciting. A goal that has no commitment yet can often be delayed, resized, or funded from irregular income. Investment tools should serve the goal because investment tools should serve the goal instead of controlling the goal. A short-term deadline invested in highly volatile assets may face price risk exactly when the money is needed. A long-term retirement goal kept entirely in cash may face purchasing power risk over decades. The tool is not good or bad by itself. It is appropriate or inappropriate for the time horizon, flexibility, and failure cost. This is why the same household can need a safety bucket, a deadline bucket, a long-term investment bucket, and a lifestyle bucket at the same time. Two extremes should be avoided because avoid two extremes. The first extreme is putting every dollar into the safest goal until long-term freedom never begins. The second extreme is putting every dollar into the most exciting goal until basic stability has no floor. A workable map gives each layer a minimum forward speed. If layer 1 is below the safety floor, it gets priority. When layer 1 is stable, layer 2 and layer 3 should also receive regular funding. Progress should be balanced enough that one goal does not silently destroy another. Household disagreements can be scored because disagreements inside a household can be turned into scores. Each person can score a goal by deadline urgency, flexibility, and failure cost. When scores differ, the family has found the real conversation. One person may treat home ownership as urgent because rental stability feels fragile. Another may treat retirement as urgent because they have seen older relatives struggle. The map does not erase values, but it forces the assumptions into the open. Once assumptions are visible, trade-offs become easier to negotiate. The plan should stay livable because keep the plan livable. A plan with no lifestyle funding may look disciplined for a month and then collapse. A plan with no safety floor may feel enjoyable until one emergency breaks it. The priority map should allow a small lifestyle layer when safety is adequate, and it should clearly reduce that layer when safety falls below the floor. Sustainability matters. A plan the household can repeat for years is stronger than a harsh plan that survives only until the next stressful week. The action step is to write a one-page rule because the action step is to write a one-page rule. For example, emergency reserve first until the floor is reached. Deadline goals second according to due date. Retirement keeps a minimum contribution. Bonuses are split across the most underfunded layers. Lifestyle upgrades pause when safety falls below the floor. Review every quarter. This rule is not permanent law. It is the default that keeps daily decisions from being rewritten by fear, guilt, or comparison.